on that one. So I think, Anuj, when you're looking at Bata today, my sense is if you're having this conversation 3 years from now, Bata is going to look like a very, very different company. I'm not surprised. The stock had dropped down to about 1150, 1200 at the peak of the pandemic from about 1900, 1950. It's not too far away from 1900 now. It's about 300 rupees off. I would not be too surprised, as the year goes on, that it not only takes out its previous high, but the valuation multiples keeps getting reset on the way up. I don't think, delving too much into these numbers is of too much academic interest to me in terms of what happened in the quarter gone by. Yes, there's been some commentary on, the cash flow situation improving to about 1100 crores for the full financial year. Some talks about increasing franchisees or probably doubling them. And things like that. But I think, Anuj, the premiumization story and the distribution story, and remember, Anuj, though they did not give the digitally assisted sales number this time, last time around when they gave it, it was almost 15%. So I think you're going to look at this company from a distribution and a premiumization standpoint very differently. If crude is to top out somewhere around here, then the gross margins of the company become even more favorable. They've already renegotiated rents with their landlords, so I don't think margins is going to be an issue. So I think the thing that has been plaguing Bata from an operational standpoint has been the top line. And I think this trinity of new, fresh blood that has come in, and Anuj, you know this better than most, that, in our FMCG sector, whenever we've had a change of guard, the market has always responded favorably. And the stock price they have become multi-baggers since then. Bata has never been a multi-bagger, over the last 5 or 6 years. No reason to suggest why that journey has not started now. So I think target multiples, earning prospects are a little academic right now because you have 3 people at the helm who could make this company look very different than it's ever looked like in the past. Full credit to the parent entity for putting this team together. But like I said, if we are having this conversation in December of this year and the stock is 2,500, I would not be surprised.
Okay. By the way, speaking of earnings and numbers, one set of numbers that the market is definitely liking is Century Ply. We should pull up the stock intraday. There's a major move that's been underway, 3.5% up. And the Q4 numbers are a solid show. There's a EBITDA gain of almost 85-86%. Margins have expanded. Revenue itself is up about 40%. Of course, it could be a low base impact as well. But anyway, those are solid numbers. So Rahul, let me ask you this. You folks also came out with a note on QSRs. There are building material stocks like Century Ply. If I were to ask you about the best reopening or recovery trades right now, or even investments right now, what would they be?
Sylvie, just to understand the question, specifically from the QSR space or just the best recovery stock across the consumer basket?
The latter, the best recovery stock across consumer.
Okay, fair enough. So I think, Sylvie, I would play Inox Leisure without batting an eyelid because Westlife is already up to about 500 or thereabouts, or very close to 500 if I'm not mistaken. And the high of the stock is about 535 rupees. So it's played out very well from about 240 or 250 on the way down. But that has not happened in the case of Inox, Sylvie. Remember, Inox is not a leveraged player like PVR is. Inox first sold off its treasury shares of about 100 crores. They did one round of dilution, and now with the news of yesterday or a couple of days back, the second round of dilution has resulted in about an 8.5% dilution, which has taken the promoter holding in the company down to about 39%, which is anywhere more than double of what PVR's promoters hold in their company. See, I think, Survi, a lot of movies have, I attended the conference calls of both PVR and Inox. A lot of movies have already been completed, have gone into post-production and are just awaiting release. And a lot of them have actually reached their finality in terms of production. So I don't think there's going to be a dearth of content that is going to come out. I think as the vaccination picks up over the next 3 to 4 months, it is very possible that as people start stepping out of their houses and wetting their feet in terms of socializing, you could have a very strong October to December quarter, for the multiplex industry. And Inox, which has done its QIP at about 315, I wouldn't be surprised if the stock is back to 500 rupees by the end of this year. So it's not a leverage player. I think the operating leverage in this business is huge because they have very high gross margins on the F&B side of the business also. Obviously, since the theaters have been shut, there's no in-house advertising that's taken place because no movies have played as such. But the gross margins on the movie side, on the advertising side is about 85-90% plus. On F&B, you're talking about 70, 75%. So you just need the footfalls to come back, Surbi. I think it's one of those few consumer discretionary or consumer plays at all that's coming to you at what, 15, 17 times FY23 P. This company could land up doing an ROE or an ROCE by FY23-24 if nothing was to go wrong from here, the kinds it's never done in the past. I mean, you're probably talking about mid to high 20s or maybe even kissing 30s by FY24. So if there's one play I would, sort of bet on in terms of opening up, is the one sector that hasn't yet opened up, which is Inox. So we really don't know the power. Remember, Surbi, at the peak of the crisis, Indian hotels had dropped down to 65. Today, that stock is quoting at about 100, 145. It's almost gone to 2.5x. Inox at the lower end went to about 250, 260. So, which is why I said if the stock is close to 500 by the end of the year, I wouldn't be too surprised.
Okay, that's interesting. Now, Rahul, the other space which is interesting, and I remember you had coverage on that, was insurance, and you like Max out of that the most. Why is that?
Yes, Anuj. We've been very positive on the insurance sector for the last 18 months, almost 20 months since we initiated. Stocks have done really, really well, Anuj. And I think the case of Max, obviously one of the biggest overhangs of the deal with Axis is done away with. I mean, if you look at the quarterly numbers, I think almost 60% of the business came in on the banker side through Axis. And whatever is left in terms of the rest of the transaction to go through, I think that will probably happen over the next 3 to 6 months. So by the time we're through with this calendar year, I think the overall transaction should be done. So that's as far as one overhang on the stock that was there moves out of the window, and you have a strong bank assurance partner and Axis that's here to stay. The second, Anuj, is that if you see the ULIP component of Max, and it's one of the reasons we've actually liked ICICI Prudential Life Insurance as well over the last couple of quarters. The ULIP component has come down by almost 500-600 basis points over the last couple of years, which is a very strong signal because the company is getting into more protection and non-par kind of businesses. At 25-26% VNB margins, Anuj, this would be one of the highest that Max has done and one of the highest for the sector as well for the quarter. Annualized, the VNB margins were about 21 or 21.5%. But the fact that they are getting into more protection and non-ULIP businesses and looking at the non-par part of the business, I think that there is case for the VNB margins to expand by another 200 to 300 basis points from here. And if this pans out, you're talking about an insurer with a return on embedded value, of close to, if I look at it in percentage terms, you're talking about 23-24% by FY23 or thereabouts. For that kind of financial profile, Anuj, the stock is coming to you at 2.6 times price to embedded value. HDFC Life is coming to you, well north of 4 times. I don't see any reason why Max cannot reset to maybe a 3.2 times, which will still give you maybe about 25-30% upside even from here. So regulatory framework, in check, valuations in check, the business metrics changing, VNB margins increasing, return ratios going up. All in all, I think if you were to look at it, a trio of the private sector, I would definitely rank this as one of the highest at this point, given the fact that it has some valuation comfort on its side as well.
Okay. Rahul, finally, before we let you go, just a thought, we're in a market which is red hot right now, lots of excitement. When you speak to clients, what is the sense? Is there a lot of money, maybe HNI money, still waiting on the sidelines, willing to buy every dip? Do you expect this to continue? Every small shakeout will simply get bought?
So, Survi, there's a very simplistic way of looking at this, right? The domestic mutual fund industry, forget the life insurance industry, the domestic mutual fund industry is 33 lakh crores today. I think 1/3 of that is equity, which you're talking about in terms of almost 11 lakh crores is the kind of, the equity investments that mutual funds have today. If people are even sitting on 5% cash of that, the amount of liquidity is just unbelievable. So demonetization has changed the way the mutual fund industry looks and feels in terms of assets under management. So at 11 lakh crores of the size of the mutual fund industry, and I'm sure there'll be another 10, 11 lakh crores if you add the equity AUM of the domestic insurance companies, ex-LIC, mind you, you're talking about an insane amount of money, almost about 2.5 lakh crores of money sitting idle in terms of cash at any point. So on current evidence, you really can't make a case for a very large fall when you have that kind of money waiting on the sideline. Can the Nifty fall 500,000 points? Of course it can. It's just part, a 7,500 Nifty has gone to 16,000. So, it's par for the course. Nadal dropped a set last night for the first time in 3 years, as Anuj would know. So, a little correction here or there does not change anything materially. Monsoons are good, vaccinations are happening, globally vaccinations are done, growth rates are all right. I see no reason to panic on the market right now. Remember, Survi, before we went into the lockdown, we were 12,500 Nifty. So if you look at it from that level, you're only about 25% higher. So I don't think it's anything too much to scoff at. Of course, some valuations do look exorbitant. There's no taking away from that, but nothing to lose sleep over. I mean, if it falls 500,000 points, if you're not betting on the Djokovic-Nadal match tomorrow, go in and buy some stocks. I mean, every fall I think would be bought into in this market.
That's the way the setup seems to be, at least for the timing. That's what we witnessed over the last couple of weeks. Rahul, thank you for joining in. Good having you on this show today. You take care and stay safe. Okay, let's quickly get back to the screen, and the screen which is still absolutely buzzing, where stocks are still flying around. Anuj, what do you make of it? I remember earlier in the week, there was also a complaint of banks sort of kind of dragging, not performing in step. And there was a question mark on whether, the bank trade is tiring out, but they've come back with a bang today.
Well, yes, it has. And sort of, I revisit the point I was making in the morning. Is the small cap space now looking exuberant? Yes. Is the small cap space now extremely overpriced? Yes. Should the small cap space now have a correction? Should that be desirable? Yes. But does that mean that correction will happen? Nobody knows. You have the 2017 example. We keep arguing that, okay, the small cap index this year has run up. Okay, that's 1 month. Small cap index is up 11%. I think this year it's up some 35 or 36%. Okay, that's 3 months. And I think if you slightly extend the timeline, you will see. But there's no Lakshman Rekha. There's nothing which says that it should stop at 35% or 37%. It could go to 80% and then fall. So all of this is conjecture, honestly. And who are we to decide what value should a stock have? The market decides that. Market overshoots and market undershoots. As I think Rahul was making a very valid point. If you remember last year, some of the prices were unbelievable. So on the way down, you didn't question them. So you don't have to question them right now on the way up. But the markets will keep giving you shakeouts. Let's be very clear about it. The one that you had yesterday, I think you'll have these kind of days. The trick would be to survive those.
Okay, that's a point well made. Okay, on that note, we also have to take a quick break. We'll come back on the other side. There's lots to cover, including obviously the last half-hour trades that will come up with Mitesh. We'll also get you all the buzz and the chatter from dealing rooms. And then, of course, ahead of earnings, we've got two PSUs which are in focus, BHEL as well as Steel Authority of India. So a heads up on both of those stocks.